One of the most common questions we get with stagflation, with inflation going on, is can I use dividend stocks to beat inflation? So first off, I don't know if I necessarily understand that question. What people to me are trying to say is, hey, costs are going up, stocks are going down. Can I get my guaranteed return of dividends? So in this video, I really want to explain dividends from beginning to end so people understand that getting a dividend is not an extra return on top of your money, okay? The other thing I want you to understand is dividends aren't always guaranteed. And this is a very, very misunderstood aspect of dividends. People see a dividend coming from a company and say, hey, this company is huge. They generate tens of billions in revenue. They can afford their dividend. But let's take a look at a couple of examples here. So let's pull up Philip Morris on our software. So Philip Morris is paying a huge dividend, almost 6% right here. And last year, if they do that, it's going to pay $7.73 billion in dividends. Now, if you've watched any of our videos in the past, I talk about free cash flow. And free cash flow is cash from operations less your capital expenditures. And one of the 5 things you can do with free cash flow is pay dividends. So how do you know that a dividend is safe? Well, what I like to do is I look at the free cash flow. And I look right above us in our software. We show the 5-year average free cash flow as well as last year's free cash flow. Guys, I will say this. Can Philip Morris afford this dividend? Yes. In the last 5 years, they averaged $9 billion in free cash flow. And in the last year, they did 11.6. But I'm not going to lie. Even though they can afford it, the question is, will it be there for a long time? This $7.73 billion is a lot. Now, let me talk to you like I'm an executive at Philip Morris. Suddenly a bear market hits and it's even worse than this today. And this stock falls in half. Well, when the stock falls in half, what happens to the dividend yield? It would double. Why? Because dividend yield is the dividends divided by the market cap. If the stock falls in half, the market cap has fallen in half. Therefore, the dividend is going to go from 6% to 12%. That's a huge dividend. But guess what Philip Morris is going to do? They're going to sit there and say, listen, 12%, that's an obscene dividend for the company. Let's cut the dividend in half. It's still going to go right back to 6%. So even though your dividend yield will be high based on where the stock price falls to, based on your investment today, your dividend yield is going to go from 6% down to 3% of your original investment. So companies use dividend yield as a way of attracting investors in. They'll sit there and say, let's pay this big dividend. It'll attract investors in. It'll keep our stock price high. I get that, but I think it's kind of misleading and manipulation. A lot of times a company you'll actually look at the dividend and say, how do they afford this dividend? Well, they're using it by taking on debt or issuing shares to get more dividend money out there to attract investors to their company, because they know that the average investor is not looking at the dividends paid versus the free cash flow. In fact, a lot of people, there's a dividend payout ratio. It goes based on earnings. And a lot of times earnings and free cash flow are very similar, as you see right here. Over the last 5 years, it was very similar. So it can be accurate. But really, I like to focus on the free cash flow because at the end of the day, free cash flow is what determines the money coming in and out of the business after all their capital expenditures and growth in the future. So that's the first thing about dividends. Second thing, I want you to understand something, guys. When you invest in a company, you're investing in a revenue stream and you're also investing in the balance sheet. Now, this balance sheet is a snapshot of what's in the company's coffers as well as what they owe, their assets and liabilities. What do they have? What do they owe? When a dividend is paid, what happens? You are decreasing the cash in the business. So theoretically, you're looking at the company and saying, we're decreasing the cash, you're taking it out of one pocket and putting it into your pocket. You're an owner of the business. Let's look at it like this. Let's say you own a company 100% of it and you run that company every day. And every year that company generates $100,000 in cash flow. If you take that $100,000 from the bank account of the company and you own 100% of it to your bank account, how much has your net worth changed? 0. Why? Because the business generates $100,000 a year. If the business is worth 10 times that amount, the business is worth $1 million, right? So if it's worth $1 million and then all of a sudden there's $0 in the bank account and no debt, it's worth $1 million. Let's say you took the business for 10 years and you didn't take any money out of the business and the business stayed the same. It's worth $1 million because it's 10 times $100,000 a year plus the $1 million in the bank account. You have to give yourself value for that $1 million in the bank account, right? So now the business is worth $2 million. But what if over those 10 years you paid out all that $1 million to yourself? Well, you have $1 million business and you have $1 million in your own personal account. You still have $2 million. It's the exact same thing. The only difference is when it comes to publicly traded companies, when they pay out that dividend, you're being taxed again. And remember, that dividend, when it was held in the company, was only taxed once, but it's after the corporate tax rate. So you were being double taxed. It's very tax inefficient for a company to pay a dividend. But most people don't know this. Most people look at it and say, oh, I'm getting extra return. You're not getting extra return. So what's my recommendation when it comes to overall dividend investing? Well, my overall recommendation is find companies that pay a dividend that they can easily afford. In my opinion, that's less than 50% of their average free cash flow over the last 5 years. Because at that point, they can afford to sit there and let free cash flow fall, let themselves reinvest back a little bit more in the company and go from there. But two, make sure it's in companies that don't have a good reason, a good way to reinvest the capital at higher rates of return. One way in which they can reinvest the capital at high rates of return is buying back their shares. And I know that Congress is trying to pass that 1% tax on share buybacks, but buying back the shares of the company is a much more efficient way and a much more profitable way for you as an investor. Let me explain how. Let's say that same company you have is worth $1 million. It generates $100,000 a year and you want to pay 10 times that. It's worth $1 million. And there are 100 shares. Each share is $10,000. Okay. Year one, the company generates $100,000 in cash. And instead of paying it out, they use that $100,000 to buy back 10 shares. So now the company has 90 shares outstanding. $1 million in value divided by 90 shares now is $11,111 per share. So they took that cash, they took the $100,000 and they bought back 10 shares. And now theoretically increase at some point, people will recognize this and say, wait a second, the stock now is worth $11,111 because now we're only splitting $1 million by 90 shares instead of 100. Do it again, another year. You buy back another 10 shares. Now you're splitting the value by 80 shares instead of 90 shares and instead of 100 the year before. Now the stock is worth $12,500. You've now increased the value of the shares by 25% by having zero growth in the company and just taking the cash, and instead of paying it out to the investors, you sit there and buy back shares. And let's say someday the market sits there and says, you know what, instead of 10 times value on the cash flow, it's now worth 15 times. It just magnifies this even more. So that's really the most efficient way that a company can use the capital of business instead of paying out dividends is by buying back shares. But you have to remember that the company is using their cash to reinvest. Even if it's in themselves, they're still investing in something. And you want to make sure they're buying back shares that are inexpensive relative to the market. That is what's important. You don't want them buying back expensive shares because that's like investing in an expensive company outside. So when it comes to dividends, I want you to remember that dividends are inefficient tax-wise, and they're used a lot of times by companies to generate a lot of interest in a company, even though it might not be the best thing for the company. It's because their incentives are to keep the stock price up. So factor that in there when you're looking at it. Understand inflation, deflation, and stagflation, because you're watching this video for that reason. You must watch this next video where I explain all three and how they work in the economy and what they mean. Thank you very much for your time. As the market falls, one of the most common questions I get is, what stocks should I be buying as the market falls? Great question. We're going to get into it right now by looking at our process for how we buy stocks.